Mortgage rates are back above 7%. The sky is falling. What does this mean for buyers? What does this mean for sellers? What does it mean for the real estate market? Stay tuned. We'll get into it. Matt, the mortgage guy, residential mortgage broker, help people buy real estate all across the country. If you look to connect with me and my team, greatmortgagebroker.com. If you find any value in this video, please like it, share it, comment, subscribe, do all the things that YouTube algorithm likes. If you want to connect with a realtor in your area, go to homeandmoney.com/Matt. So I want to talk about the good, the bad, and the ugly with 7% interest rates. Anybody who's involved in real estate, from a real estate agent to a mortgage professional to a buyer looking to buy, knows that interest rates have gone up a ton. And here we are back up above 7%. What does that mean for you as a buyer, as a seller, or anybody else involved in real estate? First, I'll kind of walk you through what I was looking at this morning as I was preparing to talk about the fact that rates have ticked back above 7%. Anybody who hasn't been paying attention, rates were literally, sub 3% a year or so ago. Early 2022, we were still in the low threes. By mid-June, we peaked above 6%. And boy, oh boy, does that have an effect on your mortgage payment. In other videos, I go into really detail about how this affects your mortgage payment. So I won't do that here, just kind of giving a history, because then by early August, we saw rates come back below 5%. And so compared to 3, it seemed high. But for people who had just done scenarios at 6 and then saw $300 or $400 relief on their payment to get a 4.99 rate, it looked really good. Okay, since August, the last 2 months haven't been so good on mortgage rates. The Fed has talked incessantly about how they're not going to slow down. They're going to continue to raise rates 4, 5, 6 meetings in a row of, this same sentiment that they're going to bring pain. They're going to continue to raise to quell inflation, no matter what it takes, right? So anyhow, peaked up above 7% last week, the last week of September. And then we saw a little relief early this week in early October, but it was very short-lived. Now here we are back above 7%. And these rates I'm talking about are a 30-year fixed for a consumer who's buying a primary residence. And it's a national average without paying points, which is more common than not these days. And also some scenarios and buyer profiles, and a broker, for example, might be lower, while other things, credit that's not perfect, working with a bank, something like that, you might be higher. So anyhow, that's that. Now that we've laid that and we've talked about rates being 7%, let's talk about the good and the bad. And I think that we'll start with the bad. 7% mortgage rate is expensive, right? The cost of borrowing is expensive. There's really no other way to put it. You match that with homes in a lot of markets that cost 30, 40, 50% more than they did only 24 to 36 months ago. It creates a big housing payment. It creates issues with affordability. There's really no sweet way to spin that, right? Like, I do the scenarios day in and day out. Home buyer who's looking to buy a house at $500,000, and they're putting 5% down, because a lot of first-time home buyers, the average down payment is 7%. So they're certainly not putting 20, 25, and 30% down. Some 3%, some 5, some 10. Call it 5%. They have a mortgage payment that's $3,500 plus, depending on where that rate lands, if they buy it down or not, right? If they went with a 7% rate, that payment's probably knocking on $4,000 a month, which, let's be honest, a lot of people just cannot do that. So affordability is an issue. Another bad thing about rates being this high is that it has really put a damper on demand, as you would imagine, right? Not as many people are buying, not as many people are able to buy or willing to buy. So some might say that demand is off of a cliff. If you're a seller, you need to understand this just as much as anybody else. Less people out there looking to buy your home. If you have an agent who's telling you, listen, we've got to reduce this by 50,000 to even have a chance at getting offers, it's not just an agent who's trying to sell the thing fast or blowing smoke. In most cases, it's just the reality. Year over year, mortgage applications are down 37%. And just this last week, it looks like demand dropped 14.2%. So demand is really quelled. More than anything, you should be aware of this as a seller of real estate. All right, let's get to the good, because there's still good. If you were active in real estate in 2020 and 2021, you know it was near impossible to get an offer accepted. $100,000 above list, waive all your contingencies, and you still had to put in 10, 12, 15 offers before you got something to stick in some cases, right? So with demand falling off a cliff, for all intents and purposes, much less competition, meaning you can go out there and you can shop, you can take your time, you can keep your contingencies in place, meaning you'll get an appraisal, you'll get to do inspections, you'll get to do all the things, and you don't have to waive that just to have a chance of getting offer accepted. That is a good thing for buyers, right? Another good is that although we say 7% interest rates, our clients aren't paying 7%. Most everyone's clients aren't paying 7%. They're finding creative ways. They're finding a combination of programs and seller concessions to really structure a mortgage that works for them. I'll give you a few examples. A seller funded 2-1 buy down is really popular. Client that just got into contract has their deal structured where it's 4.5% in year one, it's 5.5% in year two, then it locks in at 6.5% for years 3 through 30. Even if they couldn't refinance and the rate went to 6.5% by year 3, they're not paying 7%, right? They're going to pay 4.5%, 5.5%. Their hope is that interest rates come back when the Fed eventually pivots. Come on, Jerome. We're rooting for you, brother. But even if not, it's 6.5%. It's not 7%, right? Other scenarios where we're able to get seller concessions, we buy it down to 5.99, we buy it down to 5.75, and people are still getting 30-year fixed rate loans in the 5s. It costs money, but more often than not, we're able to negotiate seller credits to pay for that. So it's not coming out of the buyer's pockets. So that's that. We're not paying 7%. Seller concessions are back. Another positive, another pro, loans like FHA loans, down payment assistance, things that really were at a disadvantage in a really hot market with multiple offers, cash offers, conventional offers. FHA and down payment assistance are back. You can get your offer accepted. You can go out there. You can use those products. In general, these are the products from demographics of first-time home buyers that really are at a disadvantage. So having those back is a good thing. They're back. Opportunity is out there to negotiate price. I know I've talked a lot about buying the rate down to 5.75 or doing a 2-1 buy down where you start at 4.5%. With that, you're also able to negotiate on price. I'm looking at stuff that, model match sold for 525, you could probably get for 450 or 475. Again, not all markets are the same. Some markets are different, but in a lot of hot markets, Boise, Idaho, Sacramento, California, Phoenix, Arizona, these places that saw massive growth, well, they got colder faster, right? And, sellers either being unrealistic, they're not able to get the same price that they got in January or February of 2022, mainly because 500 with a 3.25 interest rate versus 450 with a 5.75 interest rate, you're still paying more per month at this lower price. Sellers are having to come down in price to match the affordability and the payment that buyers want to pay. So you're going to pay less. If you're able to refinance to a lower rate in the future, great, right? If nothing else, your property taxes are less and you're paying less for the property, meaning you owe less to the bank. Also, last but not least, buying a home for the long term is still the number one way for the average American to build wealth. It's just always been that way, will always be that way. If you look at any time period and you have a big enough time horizon, a decade or 2 or 3, building wealth by owning real estate is just not only as close as you can come to a sure thing, it's really reliable, it's really stable. Like the average net worth of a homeowner versus a renter, 40x or something ridiculous. I've seen some things, and I won't get into it in this video, but like, oh, if you rent, but then you took the difference between the rent and some of the costs of owning a home and you invested that in an S&P 9 billion and that got an 8% return, then over time, you're going to do better as a renter. How has that worked out for renters? How has that worked out? The data is in. The average homeowner has 40x the net worth of the average renter. No matter how you slice it, if you're paying $2,000 a month, that $24,000 a year brings no benefit. Rents continue to rise, so that $24,000 a year in a decade might be $30,000 a year that same landlord is able to charge. That's one of the beauties of owning rental real estate and investment real estate is rents go up over time. You can charge more, right? As a homeowner, you lock in a payment. You're not only paying down the principal to where you owe less, but the thing's appreciating over time. Again, don't get twisted. Year over year, I'm not going to say every year you can depend on 5.5 appreciation. Over time, real estate appreciates. That's a fact. All right, enough about that. Again, if you want to connect with me and my team, greatmortgagebroker.com. If you want to connect with an agent in your area, no matter where you're at across the country, homeandmoney.com/Matt. Thanks for watching. I hope you got some value. Like, comment, subscribe, leave some feedback, good or bad. Love to hear it. Thanks for watching. Bye-bye.